Matthew Luzzetti is the Chief U.S. Economist at Deutsche Bank, and he joins me now from New York. Good to see you, especially on a day where we can say, you know, you very early on, you and your bank warned of recession. What do you make of this latest jobs report and more broadly of recent data that we've seen from the U.S. economy?
Sure. First, thanks so much for having me. I think it was a solid jobs report, adding nearly right around 370,000 jobs in the month, a lot more than anticipated. The unemployment rate staying steady at a very low level of 3.6%. There's broader measures of labor market slack, one called the U6 rate that takes account of those that are marginally attached. That actually fell to a record low level. I think, as you mentioned, wage growth was firm. So it was a jobs report that I think was very sturdy, keeps the pressure on the Fed, certainly looking forward. And as we look ahead, I think it's a report that says the economy is most likely not heading into a recession immediately, as in the second half of the year, but it's one where we'll continue to produce price pressures that keeps the Fed on a hawkish setting. And so we still see a recession as a base case next year. Our baseline is that it happens around the middle of next year, and it's driven by monetary policy tightening.
When you see these labor numbers, though, some people are having trouble trying to square the fact that you'd have such a strong labor market, but would also have a recession. No one's saying it's impossible. It's just difficult to try and figure out what that looks like, even in your base case.
Absolutely. It's actually quite a messy picture for the U.S. economy. If you think about it, the economy contracted according to GDP in the first quarter of the year. We expect that it's actually going to contract again in the second quarter of the year. And even over the first half of the year, the economy added about 450,000 jobs on average. So there is this dichotomy, certainly, between the GDP data and what we're seeing with the labor market data. But I think what the main story at the moment is you have a very tight labor market, one that Chair Powell has said is tight to an unhealthy degree. We expect that it continues to produce wage pressures that will be inflationary, and that there will therefore eventually push the Fed to tighten monetary policy more aggressively. We see the Fed funds rate, their monetary policy rate, getting up to 4.1% in the first quarter of next year, and that's the ultimate trigger of the downturn for the U.S. economy next year.
Yeah, I look at some of the Fed rates, though, and I wonder if the market's priced any of this in, because when I look at wage growth, I think there's no turning back from that. I mean, what do you think? Some people looked at it and thought, well, it's moderating, it's around 5%. Given a tight labor market, is there really any hope that higher wages won't fuel more inflation?
Yes, certainly you are seeing wage growth moderating, but as you note, it is from a very high level, and it is still much higher than what we saw pre-COVID. And so it is still a source of upside inflationary pressure for the Fed. What we've seen is, from a market perspective, in response to today's data, the yield curve shifted upward. The market is pricing in a more aggressive and a more hawkish monetary policy response. We think that the Fed raises rates by 75 basis points again at the end of this month. But ultimately, I think that the Fed will have to go further than what the market is currently pricing. The market is currently saying that the Fed is going to get to about 3.5% and then stop, mostly driven by recessionary fears in the near term. But I think what we see is a labor market that is strong enough to push the Fed into a more aggressive stance, certainly over the coming quarters.
Which point to hopefully a shorter, less shallow recession, even if we have one in 2023. You know, there's been something that's been eating at a lot of people, and that has to do with what is responsible for inflation that many people in their lifetimes haven't seen. You know, Joe Biden and Jeff Bezos got into a spat on Twitter. Now, the president basically saying in a tweet, look, he wants gas companies to bring down the price at the pump. And yet you have Jeff Bezos really quite pointedly saying, look, you're either misdirected or you're misinformed. He didn't believe that any kind of gouging at the pump had anything to do with inflation. Now, I understand that, in fact, there's empirical evidence that would say otherwise. Not that he's 100% wrong, but what do you think? Where do you stand on that? Because I know that there are studies that show that at times when companies have so much pricing power, that in fact it does add to inflation.
Sure. I guess that I would certainly approach it from a macroeconomic perspective. And I think what we're seeing is, yes, obviously you have very strong price pressures in food and energy being driven by commodities. But at the moment, we have very broad-based price pressures. What we've seen in terms of measures such as trimmed mean, which is a measure of the underlying distribution, kind of the center of the distribution, these are at several decade highs. You have inflationary pressures that are certainly within the services sector, but also within the goods sector. And so when I look at it, it's an economy that very clearly has supply-demand imbalances, for where demand has been elevated both due to fiscal stimulus and monetary policy support. And an economy that is still suffering from some supply constraints. And those imbalances between supply and demand at the moment are producing very substantial and broad-based price pressures. We expect that continues going forward. We've seen it particularly with services. Rent inflation is hitting several decade highs. I think that continues, and that certainly keeps the pressure on the Fed to continue to tighten monetary policy.
Okay, now I have to go, but for those of us who didn't want to be in an economic class, because I loved my economics classes, Jeff Bezos is right or the president is right? Do you think there is some room in the middle there?
So I think it's all about macroeconomics at the moment, and you have very high and elevated demand against supply constraints. And I wouldn't focus on any particular sector. The inflation data that we are seeing is very broad-based. It's in energy, it's in food, it's in services, it's in goods. And so it is a macroeconomic story where you have very elevated demand being driven by fiscal and monetary stimulus against supply that has been constrained.
All right, and I will have to leave it there. Matthew, thanks so much. Have a great weekend. Really appreciate it.